This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Now, the last time the S&P was at 3,400 in the middle of September, gold was up near 1980. So maybe we'll move to catch up soon. I don't know about you, 1980 gold would sure make me feel better. Maybe that'll come after the FOMC minutes this week. Well, I don't know. We'll see, but I think that's interesting. All right, we have a moment of truth here in the dollar index. That's your next chart, the fifth one on this page. Again, we started talking about this late last week. Once we held below 94, seemed an eventuality that we're going to fall toward this trend line off of September 1st. We did that today, just barely eked out a close above the trend line. But I suspect my trend line's not important as the 50-day. 50-day down here at 93.27. We may bounce tomorrow, and maybe we'll just go right back up through 94 later this week. But if we continue to fall off here, not only breaking this trend line, but getting back below the 50-day, eventually gold is going to surge even farther, maybe to that 1980 that we just mentioned. And again, maybe all of this will center around those minutes in 2 days. And then finally to the daily charts. Again, I went with the longer term daily chart of gold to show you where, if we do continue to rally, where we're going to run into some trouble. First and foremost, as we've been telling you, got to get above 1920 on a daily closing basis. Then above there, this trend line that was the top part of the pennant that was broken down 2 weeks ago today. That trend line now tomorrow is going to be what? Around 1950? Later this week, 1940. And again, the 50-day moving average is flattened out at 1954. I think we can at least, if we can get above the trend line, we can get to 1954, which again is only what, $35 from here? Well, hell, we're $35 off of today's lows. So it's, we can get there. Okay, here's a chart that I included in my Sprott post this week. Again, I just want to show you how this is done. I referenced it earlier for anybody, like I said, foolishly thinking that somehow the manipulation has ended. It hasn't. They still have all the tools in their toolbox. One of them is to cap price at an obvious level, like we pointed out yesterday, run the algos to keep it from happening. And then again, look at the volume spikes today. All of them except one. And look at the volume spike. With the green one at about 8:30 produced a whopping $3 move to the highs of the day. All of the other spikes are red. Don't be confused by the one at 11. That candle just reversed, and since it's a green 2-minute candle off of that low at 1906, it makes it a green volume spike. For all intents and purposes, that should be red too. Also like the one that you see just before 2 o'clock, just because the candle turned green, as at the last minute we came off that low by $4 or whatever. That is a volume, all red volume surges. Okay? On what otherwise was a quiet day. This is clear footprints of bank manipulation. Whatever. You're going to have to take my word for it. I've been doing this crap now for over 10 years. Okay? That's what this is. Again, don't believe this silly notion that somehow the banks are now on your side because they're so afraid of the SEC, and the Department of Justice. Oh, no. You think Jamie Dimon is actually afraid of the Department of Justice? Come on, man. All right, so your daily chart. Again, I was optimistic yesterday. Really thought we had a chance to get above 1920 regardless of what I saw. And now, here we are. So at the risk of seeming like Whipsaw Clive, I got to tell you what I see. And what I see here is another big, massive red candle. This is 5 of them now, coming at the beginning of a down move. And they're all about the same. Big red candle on August the 7th. Okay, we eventually fell $200. Big red candle. Then about a week later, as price fell from $2,000 down to $19.20. Another big red candle in early September led to about a $50, $60 drop. Another big red candle 2 weeks ago, Monday, fell from $19.60 down to $18.50. Another big red candle today. I just can't imagine looking at this that we are not set up for a test of those lows from 2 weeks ago. Now, it was a pretty solid low. Remember, there were 3 bounces off of $18.50 on the intraday chart. That looked pretty good. Maybe we're just going to come down here and put a double bottom on the daily chart. Okay? But it's pretty hard not to think we're not going to head down there after the disgusting ridiculousness that we saw today. Second thing I want to point out to you, another zero hedge link. And I got to tell you, this caught my eye because remember last week we talked about the debt clock. You remember? And I had about 3 or 4 screenshots of part of the debt clock, and a total debt, and because we were right at the end of the fiscal year. Well, one of the things that I saw in there, and I have a screenshot on this page, you probably already seen it, was the line item interest on the debt. And off of that debt clock, it was something like $340 billion. And you just assume that stuff is accurate, right? You're like, okay. And then I thought, that's odd. That's surprising. I guess they really run everything into the shortest maturities. They must have really got everything down under 2 years, and stuff. Because to crank out, if the total debt's $27 trillion and you're only paying $340 billion, that's not even 1.5%. And I thought, but whatever. I kind of, moved on to other parts of that debt clock. Didn't really think much about it. Well, then I saw this story today from Zero Hedge, and it's got this chart that you see also on this page where somebody went in and looked at the spreadsheet put out by the whatever it is, Office of Management and Budget. Maybe I've got the link here from the source of Zero Hedge. This is from the Treasury Direct website. Okay. Monthly and annual interest paid on Treasury debt. Now, without looking at the article, just look at the spreadsheet. I pulled it off here. See the red box over $368 billion, which is kind of close to that debt clock number? Okay, now look at the numbers. Just glance at them real quick. Is there any way that the average of those 12 numbers is $30 billion a month? Let's see here. We got 33, 47, 68, 41, 94. There ain't no way. And so all of a sudden you think, well, that can't be right. Again, this is from the Treasury Direct website. So then when you do add it all up, it comes to like $540 billion. Well, now wait a second. What is it? That's an additional $150 billion. You can't just say that's a rounding error. But maybe that's where we are in the madness of it all. But again, just shows you, well, there's lies, damn lies, and government statistics. Okay, what you have here is a weekly chart of the dollar index. We're talking about a lot about the daily chart, the 50-day moving average, which is down there, if I recall, around 93.30 or so, 93.28. You really want something to pull for tomorrow? How about a trip down to the 50-day moving average? How about a close below there? But again, it's going to take some headlines and some unforeseen events likely to make that happen. But let's just look at it at the bigger picture. That's why I like to use the weekly chart sometimes. And I use just a 1-year weekly chart so that the candles are really big so you can be sure to see them. And you can see them here. Again, we have been in a range ever since the dollar kind of bottomed out in late July when gold was up at nearly 2,100 and silver was nearly 30 in late July and early August. The dollar index was in between 92.50 and 94. Closing those 2 weeks at 93.50. Where are we now? 93.60. So is gold back to near 21? No, it's not, is it? How about that? Well, anyway, we're in this range, okay? And 2 weeks ago, everybody was all excited. All the dollar bulls. Oh, here we go. The dollar's only down 10% in 6 months, but all of a sudden it moves from 93 to 94.50 and everybody's, oh, here comes a big rally. Well, maybe not so much, falling back below 94 on a weekly closing basis last week. And now, if you want to watch anything tomorrow, we always talk about, don't get too distracted by the intraday tick for tick noise, especially in the metals. But let's watch the dollar index tomorrow. Be very curious to see if not only can we close below 94, can you see where last week's intra-week low, the tail hanging out of that candle, is at about at 93.50? I would very much like to see a low and a close below last week's intra-week low, okay? Notice in the declines, go back to May, okay, when we fell back from 100.5 and fell through 100. See that kind of hammer thingy candle there right in the middle of May? Notice when we really started breaking down. See how we closed below the intra-week low? That led to even more selling the following week. Look at when we started to collapse again, after kind of stabilizing through June. Look at when it started to collapse again beginning in July. Right on the month of July. See that kind of candle with the tail hanging down at about 96 and a quarter? See how we closed at 96 the next week, then closed at 94.50 the next week, and then closed at 93.50 the next. See how that builds upon itself? So what we'd like to see, if we're going to get further weakness, one of the signs we'd get ahead of time would be a close tomorrow below last week's intra-week low at 93.5. Again, wrapping up today, 93.60. Okay? So you want a little help here. You want a little tailwind to try to get us back above 1920 and 24.50 in the precious metals. Let's stay below 94, but preferably let's get even below 93.50. And if you really want to see something happen, let's get down to that 50-day moving average, which is down near 93.30.